Revenue tells us how much business a company generates. Profit tells us what remains after expenses. But, there is another absolutely crucial question we need to ask as investors. Where is the cash? Welcome back to The Explainer. Now, in our last breakdown, we looked at Indo-MIM's revenue and profitability. And honestly, the numbers looked pretty impressive on paper. But as any seasoned analyst will tell you, a company can report these massive accounting profits while its actual cash situation tells a completely different story. So today, we're flipping from the income statement over to the balance sheet. We're going to dive straight into the DRHP to uncover the actual cash reality of Indo-MIM. We'll trace the money to understand exactly what they own, what they owe, and whether all those profits are actually turning into operating cash. Because here's the thing. A business cannot pay its employees, its suppliers, or its debts with accounting profits, right? It pays them with cash. If a company is growing its sales but its bank accounts are shrinking, well, it usually means that capital is getting trapped somewhere inside the business. So we need to follow the money. We have to look past those shiny profit margins and see how management is actually deploying capital, how they're funding their expansion, and how healthy their financial foundation truly is as they gear up for their IPO.
So here is our roadmap for today. 1, we'll take a balance sheet snapshot. 2, we'll look at what Indo-MIM owns. 3, we'll find the trapped cash. 4, how is it funded? And finally, number 5, the final cash position. Let's just jump right in.
Chapter 1, Balance Sheet Snapshot. Okay, before we get completely lost in the weeds of all these individual line items, we need to set up Indo-MIM's financial foundation. Going straight off the DRHP, it's really important to categorize the timeline of their capital. Basically, assets and liabilities are classified as current if they're expected to be settled within a normal operating cycle, or 12 months. So think short term. Non-current items, those are your long-term foundations like heavy machinery or multi-year bank loans. Now, looking at the last 3 fiscal years up to March 31, 2025, there is an immediate, glaring contrast. Total equity, which is the shareholders' funds, is growing steadily, hitting nearly 22 billion rupees by FY25. Total borrowings, or their debt, is also climbing pretty sharply, jumping from about 8 billion in FY23 to over 12.4 billion in FY25. So they're bringing in a lot more capital. But look at the bottom line. Cash and cash equivalents is moving in the exact opposite direction. It dropped from 3.3 billion rupees down to just 1.7 billion. They are raising more debt, retaining earnings, but their cash pile has literally shrunk by half. So, where is the money actually going?
Chapter 2. What does Indo-MIM own?
To figure out where that cash went, we have to look at their assets. When a heavy manufacturing company like Indo-MIM raises debt or keeps its profits, it's usually reinvesting that capital to expand. And looking at their major non-current assets, the absolute biggest line item is property, plant, and equipment. Back in FY23, the net block of PPE was 11.9 billion rupees. By the end of March 2025, that figure swelled to over 15.1 billion rupees. I mean, that is massive capital expenditure. They are buying land, building facilities, and installing these highly specialized machines for their metal injection molding operations. And all of that physical expansion directly eats up cash. But it doesn't just stop with the assets that are already up and running. Take a look at capital work in progress, which sat at roughly 1.69 billion rupees for FY25. The DRHP defines this as the cost of fixed assets that are not yet available for use. Basically, Indo-MIM has a huge footprint of active, revenue-generating machinery, but they also have almost 1.7 billion rupees tied up in ongoing construction projects for future capacity. That is cash out the door today for a benefit they won't actually see until tomorrow. Chapter 3, Trapped Cash. We're talking inventory and receivables. While buying land and machines is obviously a long-term play, a company also needs to fund its day-to-day operations. If you ever want to know why a highly profitable company suddenly feels cash poor, you look at their working capital. Tracking Indo-MIM's inventory over this 3-year period, we see that in FY23, they held nearly 6 billion rupees in inventory. Fast forward to FY25, and that number spiked dramatically to almost 8.99 billion rupees. That is an enormous amount of capital just sitting on warehouse shelves in the form of raw materials and finished goods. When inventory balloons like this, it acts like a giant sponge, just soaking up operating cash. Now, rather than us just guessing why inventory and receivables are fluctuating, let's look strictly at management's own words in the DRHP. When explaining some variances in quarterly returns provided to banks versus their actual books, management stated, quote, "The difference is majorly due to reporting of goods in transit, non-reporting of raw material, and valuation-related adjustments." What we should really take away from this is that tracking global supply chains is complicated. As Indo-MIM's global footprint expands, the raw volume of materials moving through their system naturally swells, and that requires a lot more working capital to sustain it. The other side of that working capital equation is trade receivables. This is money owed by customers for goods that have already been delivered. In FY23, this stood at about 5 billion rupees. By FY25, it grew to 6.4 billion. But here's the crucial part. Trade receivables as a percentage of revenue has remained incredibly stable, hovering right around 19%. This tells us they aren't necessarily getting worse at collecting money. It's just that as their revenue scales up, the sheer volume of those customer IOUs scales up with it. Nearly 20% of their annual revenue is locked up in unpaid invoices at year-end. Between this and the 8.9 billion in inventory, well, we found up trapped cash. Chapter 4. How is it funded?
Okay, so we've seen that Indo-MIM has spent heavily on physical expansion and has billions tied up in working capital. So, who actually paid for all of this? If we look at the funding of these assets, it essentially comes from three main buckets. Step 1, equity from shareholders. Step 2, borrowings from banks. And Step 3, other liabilities like payables. Add those together, and you get Step 4, the total funding of assets. We already saw their equity grew, but to fund this aggressive expansion, management really had to lean on debt.
And here is the real impact of leaning on that debt. As of March 31st, 2025, Indo-MIM's total borrowings hit a staggering 12.47 billion rupees. Remember, just 2 years prior in FY23, this was around 8 billion. That's an increase of over 4 billion rupees in debt in a very short time frame. Breaking down that debt structure actually tells a pretty fascinating story. Of that 12.47 billion, roughly 5.2 billion is non-current borrowings. These are long-term debts like term loans, which are typically used to finance heavy machinery and factory purchases. But the larger chunk, 7.25 billion rupees, is current borrowings. These are short-term loans, like working capital facilities, that are repayable on demand or within a year. The reason they have so much short-term debt is precisely to fund that massive spike in inventory and trade receivables we just talked about. They are borrowing cash from the bank today to pay their suppliers, while they wait for their customers to pay them tomorrow.
And this brings us right to the core purpose of their upcoming IPO. The DRHP states this explicitly. Our company proposes to utilize an estimated amount of 7,200.00 million rupees from the net proceeds towards repayment/prepayment, in part or in full, of all or portion of certain outstanding borrowings. Let that sink in. Wiping out 7.2 billion rupees of debt is a primary objective of this public offer. They've aggressively expanded using debt, and now they are looking to the public markets to deleverage that balance sheet.
Chapter 5. The final cash position.
So we've traced the money through the factories, the warehouses, and the banks. Now let's put the accounting profits side by side with the actual cash left in the bank. For the year ended March 31st, 2025, Indo-MIM reported a very healthy restated profit of 4.23 billion rupees. But right beneath it, their actual cash and cash equivalents at the end of that same period was only 1.74 billion rupees. Keep in mind, back in FY23, they had over 3.3 billion in cash. This continuous 3-year decline in actual cash reserves, it's not a mistake. It's not an accounting error. It is the direct result of a management team prioritizing aggressive physical expansion and navigating ballooning working capital needs. The profits are absolutely real, but they are immediately being converted into physical assets, inventory, and covering customer credit, rather than just sitting idly in a bank account. But before we assume this cash drain is a giant red flag, we really have to contextualize it with one of the most critical ratios provided in the DRHP: net debt to EBITDA. For FY25, this stood at 1.15. This ratio measures a company's financial leverage and its ability to pay off its debt using its operational earnings. A ratio of 1.15 is generally considered quite healthy for a capital-intensive manufacturing business. It shows us that while cash is shrinking and gross debt is rising, the company's operational cash earnings, the EBITDA, are growing enough to keep the leverage completely manageable. The debt is funding growth, and that growth is generating earnings. So to summarize our whole investigation today, Indo-MIM is a company in aggressive growth mode. They are pouring capital into property, plant, and equipment to build future capacity.
At the exact same time, their massive scale is locking up billions of rupees in inventory and trade receivables. Because this rapid expansion outpaces the cash they generate from daily operations, they've relied heavily on debt, specifically short-term working capital loans, to bridge that gap. And that perfectly explains the shrinking cash balance despite reporting robust, multi-billion rupee accounting profits. The money isn't gone, it's just out there on the factory floor.
Which leaves us with one final, provocative question. We know they are coming to the market to raise funds. And we know exactly where 722 billion rupees of that money is going, straight to paying down that massive debt burden. As Indo-MIM prepares for its IPO, will this 7,200 million rupee debt repayment be the silver bullet they need to finally untrap their cash flow, reduce their interest burden, and let those accounting profits actually translate into a swelling bank account? Or will the demands of their continued expansion just end up consuming the new capital too? It's a fascinating scenario to watch. Thank you so much for joining me on this deep dive into Indo-MIM's balance sheet. Keep learning, keep questioning the numbers, and I'll catch you in the next explainer.